Welcome to vTalkInsight, Market Drivers Daily for January 5th, 2026. AI, accelerating growth, and rising geopolitical tension are colliding to set the tone for markets this year. So let's unpack how those forces are shaping the opportunity and risk backdrop. AI remains the dominant macro and market driver, but the story is shifting from simply owning the theme to understanding where the next leg of value is created. For 2026, expectations point to a major inflection, with leading tech stocks projected to deliver gains in the low to mid-20s as AI monetization moves beyond the very largest platforms. At the same time, only a small fraction of U.S. companies have actually implemented AI so far, which suggests a long adoption runway, but also raises questions about how quickly productivity and profits will spread beyond early winners. Compared with recent months, when the focus was mainly on AI enthusiasm and index concentration, attention is now firmly on execution and capital intensity. Big technology firms are expected to commit around $600 billion in capital expenditures, driving an AI arms race across chips, data centers, and power infrastructure. NVIDIA and Microsoft are seen several years ahead of global competitors in AI hardware and software, with NVIDIA expanding into dedicated accelerator and inference markets through acquisitions, and Microsoft positioned for roughly $25 to $30 billion of incremental AI revenue that investors do not yet fully price in. Vertical integration is emerging as a key competitive edge. Players like Google, which combine proprietary data, in-house chip design, and control of the software stack, are viewed as better insulated as AI applications at the front end become easier to replicate. Physical AI is also moving to the forefront, with humanoid and autonomous robotics expected to be central at upcoming tech showcases, and names such as NVIDIA and Tesla highlighted as potential beneficiaries as AI shift from cloud to machines in the real world. Leadership is still anchored in U.S. megacaps and the so-called Magnificent Seven, which continue to attract incremental flows on AI optimism. Yet there are clear signs of regional broadening. Asian technology firms such as SK Hynix and Kyoka have delivered outsized equity gains as they pivot toward AI and high-value memory. And a wave of Chinese AI-related listings is anticipated after strong debuts like Shanghai Byron's near 76% surge. Even so, U.S. names are still judged to be 4 to 5 years ahead in cutting-edge AI chips, underscoring that global competition is intensifying, but the innovation gap has not closed. Beneath the megacaps, a very different AI cohort is taking shape. Software startups with minimal headcount are generating surprisingly high revenues, hinting at a potential wave of disruption to larger incumbents over the next few years. In digital assets, firms like BitDigital are pivoting from pure crypto treasuries toward AI infrastructure, backed by long-dated contracts, while AI-driven cybersecurity startups are expected to fuel consolidation as larger platforms seek more data and better threat intelligence. The counterpoint is that valuations and expectations are already elevated. Recent commentary stresses that repeating last year's AI and data center style returns is unlikely, which puts more pressure on stock selection and on delivering tangible earnings growth. There are also signs of uneven demand across end markets, with rising memory prices pushing up PC production costs at the same time as forecasts for AI-enabled PC shipments range from flat to declining. And concerns remain that AI-driven automation could erode jobs in areas like driving and call centers, with knock-on effects for consumer spending and growth. From here, key watch points include AI infrastructure guidance from leaders such as NVIDIA, Micron, and Broadcom, announcements on robotics and physical AI at major tech events, and the reception of new Asian AI listings. Investors are also likely to track whether AI adoption metrics start to move beyond the current small share of corporates, and how quickly incremental AI revenues appear in reported numbers for names like Microsoft and the broader communication and software complex. All of this AI, spending, and potential productivity gain feeds directly into the broader growth picture, which is where the market narrative is now turning. The macro backdrop for 2026 is notably more constructive than the caution seen late last year, especially in the United States. Growth is expected to accelerate, underpinned by resilient consumer demand, additional fiscal stimulus, stronger bank lending, and a lagged impact of earlier rate cuts from the Federal Reserve. Against that backdrop, U.S. equities are projected to have another solid year, supported by faster S&P 500 earnings growth and ongoing support from AI-related investment rather than restrictive central bank policy. Earnings expectations help explain the improved tone. Consensus points to around 14% earnings growth for the S&P 500 in 2026, with technology still leading, but important contributions from industrials and financials. Tech sector earnings alone are projected to grow in the mid-20s, while major U.S. banks are seeing upward revisions on the back of firmer net interest margins, strong loan demand, and healthy capital markets activity, including mergers, acquisitions, and a reopening of the IPO window. On the ground, the U.S. consumer remains a crucial pillar. Holiday retail sales rose about 4% year-on-year, helped by strong employment even as credit card balances climb and savings settle back toward pre-pandemic norms. Large retailers like Amazon, Walmart, and Costco are capturing most of that growth, with Amazon favored for faster revenue expansion and logistics investment, while Walmart is expected to outperform thanks to strong execution in both value and premium segments and a rapidly scaling digital advertising business that already generates roughly $5 billion at very high margins with potential to grow multiples from here. Beyond traditional sectors, several new growth pockets are coming into focus. Institutional adoption of crypto is forecast to accelerate, with Ethereum seen as a key beneficiary because of its established infrastructure and improving regulatory clarity. Platforms like Coinbase, which are rolling out scalable crypto payment solutions and white-label stablecoin offerings, and networks such as Visa working with Circle on stablecoin-based remittances into markets where fees can run as high as 6%, highlight how payment rails and fintech could capture a growing share of transaction economics as rates drift lower and deregulation gradually advances. There are also signs of broadening momentum beneath the surface of headline indices. Communication services remains a favored area thanks to double-digit growth in earnings, revenues, and margins, offering a mix of growth and defensiveness, while selected aerospace names are outperforming on the back of fresh capital and new product lines such as gas turbines. In entertainment, family-oriented franchises are expected to drive box office performance, as studios lean into content that can attract both children and adults, building on post-pandemic successes. The growth narrative is not without challenges. Elevated equity valuations and strong consensus optimism mean that disappointment on earnings or margins could be punished more quickly, and there are early signs of stress in areas like autos. Tesla's vehicle deliveries are projected to decline for a second year, even as the company shifts its story toward autonomy, robotics, and energy, and there is notable execution risk around its camera-only self-driving strategy, while Europe is showing stagflationary tendencies, suggesting that growth and inflation dynamics there may require different diversification choices compared with the U.S. or Asia. Going forward, markets are likely to focus on whether equity gains genuinely broaden beyond U.S. megacap tech, how consumer spending holds up as credit metrics evolve, and how quickly forecast earnings growth in financials, industrials, and communication services is realized. Institutional crypto flows, the performance of large retailers, and the pace of IPO and merger activity will all help confirm whether this constructive growth picture is durable or already priced in. A significant swing factor in that equation is geopolitical risk and the rewiring of global supply chains, which are increasingly shaping both corporate strategy and cross-asset performance. Geopolitics has shifted from a background risk to a structural driver of capital allocation, particularly through its impact on supply chains. U.S.-China rivalry now spans AI chips, energy, and critical minerals, and that competition is prompting a deliberate push to rebuild domestic and allied industrial bases, especially in semiconductors and rare earths. This multi-year effort is intertwined with a broader build-out of U.S. manufacturing and energy infrastructure, which is expected to support demand for metals like copper, aluminum, and steel well beyond the current cycle. Instead of a simple reshoring story, production is increasingly being redirected toward lower tariff and politically aligned countries, notably in Latin America. The United States is investing in domestic semiconductor capacity, with support for national champions such as Intel, and encouraging end users to consume more U.S.-made chips in the name of resilience. At the same time, Washington is working to counter China's influence in Latin America by seeking a greater role for American firms in infrastructure and post-conflict reconstruction, effectively using supply chain rewiring as a diplomatic tool. Critical minerals are a central pressure point. The U.S. is prioritizing domestic refining and processing of rare earths and other key materials, and government incentives are drawing private equity and corporates into new mining and processing projects. Yet progress depends heavily on deregulation and state-level policy support, which remains uneven. In the near term, the U.S. has limited tools to offset China's dominant position in rare earths, helping explain a more conciliatory tone in some aspects of bilateral policy. Energy and regional flashpoints add further layers of risk. Escalating U.S. pressure on Venezuela, including restrictions on oil exports and sanctions linked to Chinese and Hong Kong-based tankers, raises the stakes for crude flows, particularly because China currently takes a large share of Venezuela's exports, and there is a meaningful possibility of political change in Caracas this year. In the Middle East, Iran's currency has lost around 60% of its value since the June conflict with Israel, highlighting severe economic strain and the potential for unrest or wider escalation. While in East Asia, any crisis over Taiwan could immediately disrupt digital infrastructure and semiconductor supply chains, likely triggering a sanctions and economic isolation response reminiscent of the Russia-Ukraine episode. For now, some of this tension remains in the realm of signaling rather than full escalation. China's military drills near Taiwan are frequent, and the U.S. response is carefully calibrated to avoid signaling weakness without provoking a direct confrontation, and certain sanctions, such as those on specific tankers, are viewed as largely symbolic with limited immediate impact. Nonetheless, these moves underscore how tightly energy markets, technology supply chains, and regional politics are intertwined, and how quickly a local flashpoint could spill into global risk assets. In markets, these dynamics are feeding into both hedging demand and real economy pricing. Gold and silver are expected to stay volatile but trend higher, supported by central bank buying and geopolitical demand, while copper and silver also benefit from AI infrastructure, green energy transition, and U.S. infrastructure projects, with tariff risks encouraging firms to shift inventories into the U.S. ahead of potential policy changes. Key watch points include concrete permitting and deregulation steps for domestic mining and refining, funding decisions for large semiconductor and infrastructure projects, corporate announcements on moving production to Latin America, and any meaningful change in the trajectory of Venezuela, Iran, or Taiwan, all of which would feed directly back into the AI and growth stories driving markets. To wrap up, the AI cycle is moving into a more demanding phase where capital intensity, monetization, and selectivity matter as much as headline growth. The macro backdrop for 2026 looks constructive but uneven across sectors and regions, and geopolitics is increasingly shaping supply chains, commodities, and risk premia rather than sitting on the sidelines. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.